In this video, I'll discuss position sizing and how having this concept wrong can break your trading aspirations, and what to do if you want to make it in the long run. Stay till the end because I will give you two methods that will preserve your account even if you're not consistent yet. Position sizing is a crucial aspect of trading and is closely tied to experience. As more experienced trader, you have the option to choose from different potentially riskier position sizing strategies. I have personally studied 33 different position sizing models, so you don't have to. But before we delve into the technical aspects of how to position your trades for profitability and success, let's review a few necessary concepts. Number 1. What is risk? Risk is defined as the amount you stand to lose per unit of your investment if the position moved against you. We will refer to this as initial risk, denoted as R. For example, if you buy a stock at $50 and set a stop loss at 40, your risk will be $10 or 1 hour. To assess the quality of a trade, we use the term R. If we are risking 1 hour, we aim for a reward of 3, resulting in a risk and reward ratio of a 3-to-1. Number 2. Expectancy. Expectancy represents the average outcome of your trading system. Expressed in terms of R or actual dollars, it is a measure that reflects the quality of your trading strategy. A positive expectancy means your system is profitable, while a negative expectancy indicates losses. Expectancy can be calculated using the following formula: average profit times probability of winning minus average loss times probability of losing, all this divided by the average risk amount or average R. By analyzing your trading history, you can determine the probability of winners and losers based on the number of trades won over total number of trades. Number 3. Frequency. Frequency refers to the number of trades you execute within a specific time period. By considering these variables and implementing a position sizing strategy, you can create a plan tailored to your needs and desires. Now, let's examine a few position sizing models that do not work and can lead to risk of ruin. I like to start this section showing this picture. This is a simulation feature that the Edgewonk, the journaling system that I use, has. It uses a Monte Carlo calculation probabilistic model based on my past performance to try to give me a futures performance of my trading system. So here you can see how I could experience a 12 trades losing streak in a 1,000 trade sample. Because we want to be prepared, let's review what the risk of ruin is. So the risk of ruin is basically the risk that you take to blow your account. Let's start with this example. Let's say we have a $20,000 trading account and we start trading 5% of the account, which is $1,000 per trade, and you don't change this amount, right, along your trading. Even if the account went up or went down, you don't change this. So you can see how those 12 trades in a row can bring the account down to minus 60%, which is $8,000. Also look how big needs to be your performance just to bring the account to break even, 150%. So that's very challenging, especially mentally after you have all these losses, right? So let's review the methods that guarantee the risk of ruin, and then we'll review the method that I use that give me more confidence to keep trading. All right, so let's start with the first method, is the Martingale method. This is basically you double down every time you lose a trade. And here's the example. With the initial balance of $20,000, you start with $1 risk, which is not realistic, but for the sake of the example, and it'll take just 15 trades to blow your account. Okay, but let's do some more realistic example. Let's say you start with $20,000, but you start risking $100. And here the risk will be 0.5%, and the new account balance will be, if you lose the trade, right, is $19,900. And the next one, the second trade, if you lost the first one, you double down. Here, let's calculate the risk that you're taking, and you see how the risk is going up, right, proportionally with the new account balance right now is this minus this. There we go. And if we extrapolate all this, there you go. It'll take only 7 trades for you to blow your account. You can see here. So not only that, let's say on the 7th trade, you double down your money. You have brought your account to 70% or 75% barely of the initial balance. So this method for me is flawed for 2 reasons. Number 1, you have a finite account balance. You cannot increase your capital as long as you are losing, right? So you have a finite amount of money, number 1. And number 2, it only works to the downside. There is no strategy if the account is growing. Meaning, if you are risking, let's say $400 and then you won the trade and you're back to, let's say, break even, there's no strategy to increase your risk as the account grows. Okay, so that's why those two reasons of this Martingale method for me does not work. The second method that I think it guarantees you lose all your money is the Joe Ross method. You can go to his website, is tradingeducators.com, and you can judge by yourself if this works. For me, it's a flawed method, but a lot of people are using it. I won't use it. This method works like this. You need to cover the entire cost of the trade with a 60% position size, meaning, and right out of the gate, he tells you to start with 5 contracts, which I don't agree because I don't know the account size that you have, if mentally you can handle a loss of 5 contracts. But for the sake of this example, let's do the 5 contracts, okay? By the way, this is a method created exclusively for futures trading. So let's say if we have a trade example in the ES, we have 5 contracts, we risk 4 points, that will bring our risk to $1,000. In theory, if we buy the 5 contracts and we close the trade after being plus 20 points, this trade would have made $5,000. But see how in this method, the asset, the underlying asset, in this case in the ES futures, has to move a lot more for you to get to those 5R. Number one, the initial risk is $1,000. You need to close the 60% position, meaning 3 contracts. And let's see, how much do we have to make with 3 contracts to cover $1,000? So here you can see $1,000 divided by $150, which is 3 contracts per point, right? And this gives us 6.67 points on the ES futures to cover $1,000 with 3 contracts. So let's round this up 6.75 because it's quarter increments. And we need to cover the rest. Now, the assumption of this method is that you move the stop to break even, so you don't have any risk. So worst case scenario is that you made $1,000 in this, after this, okay? How much the 40% has to move in order for you to make $4,000 divided by 100, it'll have to move 40 points. So you can see here how the ES, the underlying asset that you're trading, needs to move 40 points, which bring the proportion of this divided by the points that we're risking a 10R, which is a lot more difficult than get a 5R. So the probability of you getting 10R is a lot lower every time you're taking this type of trades. So for me, it has 2 flaws. Number one, your initial risk is the maximum and the position still hasn't been proved that it's going to work. Meaning, so you take right out of the gate the maximum risk you can take. Whereas, look at this difference. What happens if you take very minimal risk and then after the position is going in your favor, you start increasing your risk? For me, it does make more logic that the market has agreed with you after you took a trade and now you are increasing your size and your risk. That's number one. Number two, for me, this method is basically cut your winners short and let your losers run. That's basically what this method tells me. And the third method that I think it guarantees the risk of ruin is this, the method that we were talking about, but in the fixed amount of dollars. Now, you can get away with this method if you have a very big bank account. Let's say you have $1 million brokerage account and you risk $1,000 per trade. That you can get away because you're risking a very low percentage of your account. So yes, this is a method that is flawed, but you can get away with it if the account is very big and you keep your risk proportionally very low. All right, now after we've seen what doesn't work, let's go to see what works. The proposed method that I use here is just a fixed percentage of your account. There are 2 things and features of this method. Number one, it gives you very low volatility. Your account as different as this one here, where you have a lot of volatility, you lose 1,600, 3,200. In this one, you have very low volatility. You basically lose something very similar, but as the account balance comes down, you are risking less and less money. Now, let's say you have 10 losing trades in a row. I recommend you to apply some binding strategies. Okay, what's going on? Is the market conditions changed, or I am not performing like I was? Mentally, I'm not in the best state. So you have time because there's not much volatility in your account. Also, your decision making is not impaired, meaning you're not doing things that are not in your trading plan because you are not affected by the losses because they're not great losses. They're just within your models. I would recommend you to have some binding strategies. Let's say after the 10th trade, I either cut my size because I'm not performing like I thought I was, number one, or I review the market, or I just go back to sim trading to see if my edge is still valid in these market conditions. That's one of the advantages, no volatility. And the second advantage is that this works when the account is decreasing in balance, you decrease your risk. But on the other side, if the account balance is growing, you increase your risk. Let's say from $25,000, now you have 25 to 50, right? And you want to take a 1% risk. This will be 252 instead of 250. Now, the new account balance is this. Now 1% again, and let's do this, 255, and so on and so forth. Okay, there you go. And you see how as long as your account balance is going up, your risk is increasing, creating this snowball effect in your account. So that's the second method. And if you're not consistent, this is the method to use because it has low volatility and it works in your favor when the account is growing. Now, if you are consistent and you know your trading style and you don't get bothered by losses, you can now go to this advanced method. This advanced method will help you grow your account exponentially if you are consistent. So again, if you're not a consistent trader, please don't do this advanced method. It only works for professional traders. Advanced method, it basically states that you risk part of the equity of your account, the gains that you have made in the account. Now, this example goes like, okay, $25,000 initial balance, but now you're making $1,500. You are making money. You're not losing money. You are making $1,500, and you still keep your 1% or 2% that you want to assign to every trade. But instead of that, you take one piece of that equity and you destine it to increase your risk. Meaning, if you're risking 265, now I want to allocate 20% of this equity or gains to my next trading idea. Meaning, all right, it'll be the 1% plus 300%, which is 20% of this $1,500. Now the new risk is 565. Now, this has a lot of implications mentally and technically. Can you handle the losses? The account can. But mentally, can you handle if you lose this trade, right? You can try once. If you lose, you evaluate how you react to the loss. If you have no reaction, and it's very important not to lie to yourself, be honest to yourself, because this is you against you. If you can handle the loss, then you can keep trying part of the equity. If you cannot handle that big of a loss because you're being risking $265, now you're increasing your risk, right? It has the possibility of it give you more equity, more gains, and this has a limitation as well. You are going to be the limitation of this method. Can you handle such a loss? So that's it. This is the two methods that I think works better, the proposed method and the advanced method. We have seen now what works and what doesn't work. This is all my opinion. But judge yourself, what method are you going to use after watching this video. Risk management and position sizing is one of the main pillars of becoming a professional trader. I hope you like this video, and if you find value in it, please consider subscribing to the channel and sharing to other people so we can continue making more content. I'll see you in the next video. Happy trading!